Hi, it's Marco here. So if you are like me, you're really tired of seeing this market that keeps on crashing and dips, that keeps on dipping. So I've got some good news for you, and that is something that really might change the way we look at market. So let's dive straight into this. So there is some data that has just come out and it was just updated in the last few days. This is the real margin debt. So debt is obviously a way to raise capital and to pump money into the stock market. So as you can see, very recently there's been a reduction of the margin debt, and as you can see here, that's when we had the peak in 2021, and the margin debt, as it says here, has decreased by 29 billion in the last 12 months. So it has gone down so much. And if you can see, these are some other examples of when the the real margin debt went down. So in the 2000 crash, the June 2007 crash. So when we had these massive crashes, or the crashes started, that's when the debt went down very drastically. So why is this very important? Well, I'm just going to tell you the story of what happens when the stock market, basically you see this reduction in margin debt, and the reason is a margin call loop. So when you get a margin call, it means that you are basically losing money on your trade because you've been borrowing, and so you then have to pay back your loan that you've been using to trade. Now this is a loop because the more people get a margin call, the more the market obviously creates more margin calls, and it's basically the reverse of when you have a short squeeze. So in a short squeeze, the price keeps on going up because stocks are being bought by the sellers of stock. In this case, the buyers of stocks that have used debt to buy stocks, well, they have to sell, and that is the problem. So it creates this obviously trajectory that it keeps going down, but overall we saw the numbers, and this is positive because the less debt, the less margin is used to buy stocks. It means that the market overall, it's becoming more stable. So that is why it's very good to have a look at the margin debt for the short but also the long run. But what I wanted to also show you is that obviously the margin debt is the first thing that you see having a bit of a hit, a bit of an issue, a bit of a hiccup, because it's very related to the interest rates. And as you saw from that chart, and I want you to have a look at it again, very important, is the fact that before these big crashes, so in 2000 and 2007, well, we saw the margin going down as if people were actually predicting there will be a crash. And so what they were doing, they were just preempting the crash. So what I basically wanted to show you is that it's very important to have a look at the margin, but then can we just say that it's really done then? We saw the margin going down. Are we actually out of the woods, and is then time to buy? Well, there is another thing that you obviously have to always keep an eye on, and it's the Federal Reserve. Now, in this case, the Federal Reserve hasn't increased the interest rates as of yet, and that's very important. On top of that, there is their balance sheet that, again, new numbers came out very recently, and it's time to have another look at it to just understand what kind of trajectory. So if you look at the old time, this is still incredibly parabolic, but let's have a look at recently. As you can see, we are approaching a bit of a plateau. Now, the plateau is going to be the phase where there is not going to be any more increase in the Federal Reserve balance sheet. But if you just look at what is going on now, we are still going up, and we are almost at the end of February. So that means that they basically told us we are not gonna have any more easy money in, basically they said it in November last year, and we are still seeing this taper that is taking forever and is doing almost nothing. I'm not sure how they want to play this out, to be entirely honest with you. It seems to be a bit of a mystery. If we go back in time and we look at when they did the other taper, they basically they said that they would do it, but in reality it took them still quite a few months. And in fact, it looks like that if we follow this pattern, they will potentially, before getting to the plateau phase, they will still be doing it, they will still be tapering for at least another 6 to 7 months, starting from today, that is February. And then after that, there is going to be the other phase, and that phase is incredibly actually bearish. I wanted to tell you the word, I didn't want to tell you the word bearish, but the extra phase that I'm gonna tell you about is incredibly bearish. And that's why I feel like now buying into this market is actually not the best strategy. Okay, this is not gonna be very popular. I just want to keep you on the right side of things. I don't think now is a good time to buy. Sorry guys. If you want to let me know your thoughts in the comment section, please do go ahead. But now it's really a bad time to buy. And you know, the numbers have shown you that and has proven me right, because I've been telling you this since November last year. And okay, that was a bit of an early call, but we saw the results. The market was keep going up, but in reality, as we saw recently, we saw that we just had a bit of a massive crash, and now we are really struggling to go up. We have this kind of convictionless rallies, and that is because after the plateauing phase, when we are gonna not grow anymore on the balance sheet of the Fed, then there is gonna be the reverse of the balance sheet. And so what is going to happen is what basically happened again in the past, back in 2018. And so as you can see from the chart, from the plateau we had in 2014, then they slowly, more or less slowly, started offloading the bonds that they bought. And if you were to just look at this, this is the real deal. This is why the stock market really crashed. As you can see, basically the balance sheet really started being offloaded very, very quickly, and the bond market became very interesting back then. So this is the phase that you really have to be scared about. Not even the interest rates increase. It's just basically the opposite of easy money. This is what is, in simple terms, the opposite of easy money for investing. And so there is still quite a few months before this kind of phase kicks in, but because this phase is very much happening, like it's many investors and myself included think that we are gonna see that happening. The Federal Reserve themselves, they say that inflation is just too big to be stopped by simply, I don't know, shouting from the rooftops. I don't know what they were trying to achieve before they started saying, hey, inflation is not transitory. It was a bit of a silly move, and to be honest, it felt like they were just, and they still are, kicking down the can down the road. So this is what is going to happen probably. Now we are gonna need to make more like videos about this. I'm gonna keep you up to date on this. So other than that, thank you for watching. See you in my next video.